with our host, Alan Porter. And our Alan Porter is a certified financial fiduciary, certified tax and business advisor, and tax strategist. Today, we're going to be talking about something that affects every retired investor and high net worth family: inflation. It's been dominating the headlines again, and for good reason. Inflation quietly erodes your purchasing power, and if you're not careful, it will derail even the best retirement plans. So let's unpack why and how the wealthy protect themselves from it by protecting your retirement from inflation. Why is inflation such a serious threat to retirement plans, Alan?
Neil, inflation is often called the silent killer. I call it the death tax, but it's a silent killer of retirement plans, and it doesn't happen overnight. It happens quietly, year after year. Even a modest 3% inflation rate can cut your purchasing power in half over 20 to 25 years. For high net worth families, that's just not a higher grocery bill. It's long-term erosion of wealth. Most retirees lived on fixed income or market-based return, which can lose real value when prices rise. So when even your account balance looks healthy, what it can buy is shrinking every year. And that's what I tell people. It's not about the rate of return on retirement. It's about distribution of your assets. And when you can have an asset that doesn't take as much to perform the same with less of that asset, you're protecting yourself from inflation.
Why are traditional investments struggling to keep up?
Traditional investments like stocks and bonds have a hard time keeping pace with inflation. Stocks can outperform inflation, but only if you handle the roller coaster ride that comes with it. It's been proven by Harvard studies that people with guaranteed income have a healthier, happier, longer, and more productive life. But understand this. Bonds, on the other hand, actually lose value when inflation and interest rates climb, because when interest rates climb, bond prices go down. The combination leaves a lot of retirees exposed, taking on the risk just to maintain the same lifestyle. And that's a dangerous game to play when you're depending on your portfolio for income. Understand this, Neil. I've said this many times. You have $1 million in a stock portfolio at a 4% distribution rate. That's supposed to be a safe distribution rate, indexed for inflation for 30 years. If you're 65, that's 95. All my retirement plans go to age 120. And let's take that $1 million stock portfolio at 40% or $40,000. That's not guaranteed. You would only need approximately $650,000 in certain fixed indexed annuities to give you the same $40,000 a year. That's guaranteed for the rest of your life up to age 120. And every time you have an increase in the indexing strategy, because we're not tied to the stock market, your increase is going to increase, your income is going to increase, and that's locked in every year. And even if that accumulation value runs out in that fixed indexed annuity, by contract, the insurance company still have to pay you that money, whether it's $40,000 a year or $50,000 a year for the rest of your life.
How do index annuities and cash value life insurance protect wealth?
Fixed index annuities like cash value life insurance are basically designed to protect your principal while still giving plenty of room for growth, because, again, as I've said many times, you're guaranteed by contract never to have a loss through the market downturn. Now, we've gone over caps, floors, and things like that, but I'd much rather have a 75 to 80% gain in the market with a zero floor, because when people don't understand, Neil, when you have a 50% loss, it takes 100% gain to get back to even. And I'll give you a Reader's Digest version of this. Let's say you have a stock portfolio of $100,000. Year one, it goes up 100%. Number two, year two, it comes down 50%. So you're right back down to 100,000. Year three, 100% gain, it's back to 200,000. Year four, you get a 50% loss. You're back down to 100,000. Now, you all hear from all these financial advisors, the average return of this. When somebody talks to you about an average return, run the other way, because the actual return is zero. You're right back to where you were before.
How do these tools tie to growth, to inflation, but guarantee principal?
Again, think of it as a one-way ratchet. When the market goes up, your gains are locked in. When it goes down, your account stays flat. You never lose principal. That's why what we mean by having a cap on the floor. Again, the floor protects you from losses, typically zero. The cap gives you a portion of the gain, usually 8 to 12%. And when properly structured cash value life insurance and fixed indexed annuities, they're guaranteed by the company, and this means your wealth continues to grow tax deferred regardless of inflation or market volatility. And if it's certain properly structured fixed and fixed index annuities and cash value life insurance, they mitigate or eliminate all the risk in retirement. And the number one fear in retirement is running out of money before you run out of life. A stock portfolio cannot guarantee that. They can guarantee you can run out of life because it's so volatile. There's one thing that many people don't understand. It's called sequence returns risk, Neil. And let's say that you got $1 million in a stock portfolio, 4% distribution rate. That's $40,000 a year. The first year you have a loss of 10%. Now that $1 million is down to 900,000 minus the 40,000 you took out for your income, minus the fees whether you pay that financial advisor, whether you make money or not. And let's say 2 to 3 years, we have 2008 happens again, where we have 38 to 52% loss in the market. You're going to be out of money in the year. And let's say basically what sequence returns risk, Neil, is if you have a loss in the market in the first 2 to 3 years of a 10 or 20 year period, as compared to the last 2 to 3 years of a 10 or 20 year period, you're going to be out of money in the 5th to the 9th year, and people aren't prepared for it. People aren't prepared for the taxation of Social Security, the means testing for Medicare Part B, which a stock portfolio will only compound, and that will be in the thousands of dollars per year with cash value life insurance and certain fixed and fixed indexed annuities when properly structured. You're protected from lawsuits, liens, and judgment. You avoid probate. There's no required minimum distribution. The list go on and on. I can mitigate or eliminate all the risk in retirement that a stock portfolio only compounds.
Why does this approach matter for retirees, Alan?
In retirement, predictable income and purchasing power are everything. You work too hard to leave your lifestyle to chance. The strategies provide stable income, long-term growth, and peace of mind. You have confidence in knowing that your income will last as long as you live, and that inflation won't steal your future buying power. It's not just about growing money. It's about protecting your freedom, your lifestyle, and your legacy.
What is the first step to building an inflation-resistant plan, Alan?
The first step is clarity. At the Strategic Wealth Strategies, we produce a plan for you. We want you to understand where we're coming. I don't care what's in your bank account. I need to know what's in your heart and mind, what you want to accomplish in life. When I can do that, then I can build a strategic plan. From there, we design a custom plan that protects your purchasing power, locks in guaranteed growth, and can even create tax-free income for life. Now, understand, people, if you're ready to talk a tax-free retirement, give me a call at 910-551-1046. I'll walk you through the same strategies that the wealthy and financial institutions have been using for decades to outpace inflation and eliminate financial risk. In closing, I'd just like to thank you for joining me. And remember, true wealth is measured in how much you make. It's measured in how much you keep and how well it works for you. Stay informed, stay protected, stay strategic. Until next time, take care, and thanks for listening.
All right. That was the Strategic Wealth Strategies podcast, guys. Take care.